Okay, so now let's talk about a specific example. So here's the story. So there are two firms, a honey farm and an apple orchard. So basically a honey producer and apple producer next to each other. So there's got to be a positive externality between the two. The apple producer produces, I'm sorry, the bee farmer produces, the honey farmer produces honey through the bees, and the bees pollinate the apple trees, and so it increases the productivity of the apple orchard. And so there is a positive externality between these two. But well, let's look at the specific details. So as I said, there a honey farm and the apple orchard each act as a competitive firm. All right, so basically they take the prices as given. So let's say the amount of apples produced are measured by A. So A denotes the number of apples, and the amount of honey produced is measured by capital H. So the cost functions of the two firms are as follows. So the honey producer's cost depends only on honey, and it's H squared divided by 100. And the apple producers, the apple orchard cost function depends only on apple, which is A squared divided by 100 minus H. So it doesn't only depend on A, it also depends on the number of honeys. All right, so the more honey, the less costly it is, which makes sense because you don't have to go through extra steps to pollinate the trees. The honeys are automatically doing it for you, so your cost is going to decrease as the number of the bees increase, and the number of bees increase means the amount of honey production increases. So okay, that's that. Well, the price of honey is $2. So price of honey is $2. Remember, both firms are acting as a competitive firm, meaning they just take the prices as given. And the price of apples is $3. Okay? So the question is, if the firms each operate independently, what would be the equilibrium amount of honey and equilibrium amount of apple? And then the second question, what is the socially efficient amount of apples and honey, and why it is socially efficient? And then the third question, in order to sort of ensure this socially efficient outcome, what would be the Pigouvian tax or subsidy? Well, so calculate it. Well, because this is a positive externality case, I mean the honey producer's actions positively increases the profit of the apple orchard. You'll see about, if H enters the cost function negative, while it enters the profit function positively. So therefore, there's a positive externality between these terms. And hence, we should be talking about Pigouvian subsidy rather than Pigouvian tax. Okay? So let's solve this problem as, well, first off, the independent. All right, so what if independent, if these firms are acting independently, and then what if they act jointly? Well, if they're acting independently, the honey producer is going to maximize its own profit, pi h. And what's its profit? Well, simple. By the way, what is it choosing? Well, it's only choosing honey. All right? What is the amount of honey to produce? Well, what's the profit for honey producer? Well, the price times the quantity, so pH times the quantity, all right? And that's it, minus the cost, CH. All right? Well, let's be specific. The pH is 2, so 2H minus the cost function, H squared divided by 100. So this is the profit function for the honey producer. Well, what about the apple orchard? Well, it's going to maximize its own profit, all right, by choosing apple only. The apple orchard does not choose the amount of honey to be produced because it doesn't grow honey bees. So the profit of the apple orchard is the price of the apple, which is PA times the amount of apple it produces minus the cost of producing apple. So just to be specific, the price of apple is $3, so it's 3A minus the cost of production is A squared divided by 100. So be careful here, it's the cost minus cost, but the cost, so minus cost means minus this term, but I am basically distributing the minus term on this cost function, so it's going to be minus A squared divided by 100 plus H. Okay, so be very clear about this. If you make that tiny, small, silly mistake, the rest of the question is going to be wrong. So don't make such silly mistakes. Just be careful, all right? So this is exactly why I said, so this is the profit function of the honey producer. This is the, so this is P honey, this is pi honey, I'm sorry, and pi apple. So the honey producer's profit depends only on honey. So so you can't influence its productivity. The apple orchard does not have any impact on the honey producer. However, the honey producer positively influences the apple orchard. So the more honey, the higher the profit for the apple orchard. So there is a positive externality. All right? So if that H was in the profit function with a minus in front of it, it would be negative externality. As simple as this. So there's nothing really sophisticated about the distinction between positive and negative externality. So, given that these are the profit functions and these are the optimization problems, the first order conditions are, well, the profit function of the honey producer with respect to the amount of honey has to be equal to 0. And then the profit function of the apple orchard with respect to A has to be equal to 0. So in this question, be careful, there's only two parameters, honey and apple. All right, there isn't a third parameter. In the theoretical discussion we had, the pollution example, we had 3 parameters, but here there's only 2. Okay? Well, here in the first order condition, you take the derivative of the honey producer. So the partial derivative is going to be 2 minus 2h divided by 100 equals 0. All right, so very simple. Let's solve this. First of all, this is, yes. I'm sorry, I don't know why this is equal to 0. This is equal to, not 100, it's equal to 0, right? The first order condition. So 0. So what do I have? I simplify this, divide, you know what? Don't cross this 2 yet. So 2 equals 2h divided by 100, all right? Do the cross product. The 2's will cancel out, and then h star is 100. So the honey producer is going to produce 100 units of honey. And then the apple producer is, if you take the derivative with respect to A, it's going to be 3 minus 2A divided by 100 equals to 0, right? And so if you solve this, do the cross product, 300 divided by 2, which is 150, which is equal to A. Let's put star. So therefore, if these two guys act independently, they're going to produce 100 honey and 150 units of apple. Okay? As simple as this. Well, what if they were acting jointly? All right? So that means the total profit is the revenue from honey plus revenue from apple minus the cost of producing honey and the cost of apple. I just add this profit with this profit. That's it. There's nothing sophisticated. So let's just write it. It's basically 2h minus h squared divided by 100 plus 3a minus a squared divided by 100 plus h. All right, that's it. That's the total profit. Well, we are going to maximize this. Well, there are 2 parameters to choose. The number of apples and the units of apples and the units of honey. So there are again 2 first order conditions. The first order condition number 1 is with respect to honey, and the first order condition with respect to apple is this. So the partial derivative with respect to honey is going to give me the derivative of 2h is only 2. The derivative of h squared minus h squared divided by 100 is basically 2h divided by 100, but I'm going to write it as 100 divided by 50. And then 3a, its derivative is 0, and then plus 1. Okay, because the derivative of h is just 1. So therefore, 3 equals h divided by 50, and hence h equals 150. As you see, it's different than that h star, so let's call it h prime, right, of h hat. So if these two firms were jointly operating, well then, rather than producing 100 honey, it would actually produce 100 and more honey. Well, why is that? Well, because, more honey is actually going to decrease the profit of the honey producer, right? Because the optimal, if you're focusing on the profit you're going to raise from the honey production, the maximum profit maximizing honey amount is 100. So you don't want to actually produce more than 100. But the thing is, the more honey is actually going to produce more apples. And so that's why you want to increase the honey production, in order to increase the apple production, because that will apparently increase the total profit. So therefore, you produce not 100, but 150 units of honey. Well, what about apples? Well, probably it's going to be either the same or more apples than 150. Let's calculate. So if you take the derivative of this profit function with respect to a, you have, again, 3 minus 2a divided by 100 equals 0. Well, you know what? A is still 150. Okay, well, it may sound weird, let's put had, because that's optimal. It's like you are producing exactly the same amount of apple, so why are you producing more apple? Well, more honey, I'm sorry. Well, you are producing more honey, not necessarily to increase your apple production, but you are decreasing the cost of apple production, and hence increasing the profit. All right, the objective is not to increase the apple production. The objective is to increase the profit. All right, so therefore the same amount of apple, so be it. What matters is the profit should be higher. All right, so now let's see why this outcome is inefficient and why this is socially efficient. Well, for this reason, we need to calculate the profits. Well, here, of course, we are looking at social efficiency. I mean, the aggregate profit is maximized. All right, that's what we care in this when we say this is inefficient and this is efficient. So here, if we let's leave the profit functions as follows. So let's erase this. So this is basically pi h, and this is pi a, the profit of the firms. And then, so I already know that the apple producer is going to produce 150 apples and 100 honey. So therefore, the honey producer, the profit is going to be 2 times 100 minus 100 squared divided by 100. So it's going to be 200 minus 100. So its profit is going to be 200 minus 100, yes. So 100 is going to be the profit of the honey producer, and the profit of the apple producer is going to be, let me double check because I really don't want to, okay. So the profit function is 3a, okay, so okay, yes, so this is 3a, which is 450 minus a squared divided by 100. So it's basically 15 times 15, 225, plus h, which is 100. So if you do that, this is, by the way, 225 is half of 450. So this is 225 plus 100, 325. So therefore, the total profit, all right, although these are independent firms, the total profit is $425. Okay? However, this is independent. If they act independently. Well, what if they act jointly? Well, if they act jointly, well, the apple honey producer is going to produce 150 units. So 150 units, the profit is 2 times 150, 300. All right, so 300 minus 150 times 150 divided by 100 means 225. So therefore 225, 300 means 75, right? Okay, so $75. And so it decreases, obviously, right? Because the highest maximum profit will be achieved if the honey producer actually produces 100. But the reason why it produces more than 100 is because it decreases the cost of the apple producers. And so, or the apple profit, apple cost, I'm sorry, cost of apple production. The apple, so the profit from the apple production is still the same, the 3A, the same thing, 325, right? Because, I'm sorry, it's not 325, because it's 3 times A, where A is 150, so it is 450, minus, again, A squared divided by 100 is 225, but H is not 100, but it's 150. So therefore, this is, again, 225 plus 150, so it's 375. So somebody's profit should be increasing. Yes. Okay, so once again, if they are acting independently, H star equals 100 and A star equals 150. And if they are acting jointly, A hat is 150 and then H hat is equal to 150. Okay, so we kind of summarized everything here. So the total profit, however, is 375 plus 75, $450. Okay, so if these two firms are acting jointly, well, then the total social profit is $450. But if they act independently, the total profit is going to be $425. So it's $25 less. So therefore, as it's obvious here, acting jointly is socially efficient. It's Pareto improvement over acting independently. All right, so because the total profit when they act jointly is higher than the total profit when they act independently, well, we say that acting jointly is Pareto improvement over acting separately. All right, and therefore, we already know that the social welfare maximizing allocation is Pareto efficient, and here the social welfare is the sum of the profits. Pi A plus pi H is the social welfare function, and this is the social welfare maximizing allocation. Well, we know that it is Pareto efficient. Remember our earlier chapter discussions, especially the very last video, as far as I remember. So this is Pareto efficient, and it's sort of obvious that it's Pareto improvement. So Pareto improvement in the sense that the social welfare, the total welfare increases. You may say, and it may confuse you, which you're right, but let me explain. Here, and this is exactly why I wrote those profits separately. So here, we keep saying this is Pareto improvement. Rather than acting independently, let them act jointly. It's Pareto improvement, I say. But clearly, the honey producer is making less profit in the joint production. Yes, the apple producer is making more profit. However, the honey producer is making less profit. So how come this is proto improvement over this one? Because we are making one agent better off, but the other agent is getting worse off. Here, the worse off agent is the honey producer, the better off agent is the apple. So by very definition, remember, the Pareto efficiency means you can't make, so, or the Pareto improvement means like you can't make one agent better off. I mean, if you're making one agent better off and hurting the other agent, it's not really Pareto improvement. Pareto improvement means both agents are getting better off. At least one is indifferent, but the other is strictly better off. But here you're making one better off and the other worse off. So how is this Pareto improvement, you may ask? Okay, so here's the thing. This is socially efficient and it is Pareto improvement because these firms can actually, well, first of all, these are not two independent firms when we think of joint production, all right? So when we think of this as joint production, it's actually just one firm and having two separate branches, and one branch is producing apple, the other branch producing honey, but the firm is now care only about the total profit. All right, so therefore, we can only compare the total profit here versus total profit here. So they're not really two separate entities. Well, one interpretation. The second interpretation, well, okay, let's say these are two independent firms still. I mean, they really care about their own profit, but they just talk to each other and say, oh, can we nevertheless, well, yes, we are independent firms. We are trying to maximize our own profits, but can we act jointly and still get better off? Well, the answer is yes, you can still get better off by acting jointly. But how come? Apple producer will get better off, but the honey producer will get worse off. Well, here's the thing. When they discuss whether to act jointly or not, they should also discuss or negotiate the following. Well, I am the honey producer is going to say, I am willing to cooperate with you and act jointly. I mean, rather than producing 100 units of apple, I'm willing to produce 150 units of apple, honey, but you must compensate me, all right? You must I mean, I know you're going to be making some additional profit. Well, I mean, 325 versus 375. So you are basically making additional $50 profit, right? And however, I am losing $25 net. So you know what? In total, however, we are making $25 net gain. So you should compensate me in some way. All right. So how is that so? For example, I mean, how could they negotiate out? Well, for example, the honey producer could say, oh, you know what? You pay me, the A pays the honey producer, say $30. All right. If they act jointly. If they act jointly. Otherwise, no payment. All right, so we call this side payment. Well, if you and I jointly, so we are independent firms, but if we act jointly, meaning you produce 150 units of honey rather than 100, well, I am going to make more profit, the apple orchard will say, but I am going to pay you, all right, as a side payment, $30. Well, what happens when they act jointly? Rather than $75, the profit of the honey producer is going to be $75 because he's producing 150 units of honey plus $30. So it's going to be $105. And the apple orchard profit is going to be, well, it's producing, I mean, it's making $375 of profit, but it's making $30 side payment to the honey producer. So therefore, it's going to left with $345. Okay? So basically they distribute the total profit. The total profit is still $450. So they just distribute the total profit in such a way that both benefit. All right? So not only the honey producer, but also the apple orchard benefits. All right? So therefore, even if these two firms are independent firms, I mean, they just care about, the honey producer cares only about the money he is going to make. I mean, I have an account and you know, the costs, the liabilities and the revenues and the net profit. At the end of the day, I care about my own net profit, and it's reducing to 75 if I produce 150 units of honey rather than 100 units of honey. So you have to compensate me. Well, how much compensation? Well, that's a discussion, right? This is one example, $30. Well, what about $35? That's still gonna make both agents better off. All right, so it's still Pareto improvement. I mean, acting jointly is still Pareto improvement. It could be $50, all right? So basically the apple orchard gives all the additional profit it gets to the honey producer. So it's still joint acting jointly is still Pareto improvement over acting independently. But it involves some side payments. Okay? Yeah, all right. Well, the one last thing is, well, what about the subsidy we need, the Pigouvian subsidy we need in order to make that the honey producer is going to produce not 100, but 150 units of honey? Well, the honey producer's profit is this, 2H minus H squared divided by 100. Agree? Well, because it's producing honey and that honey production positively increases the revenue of the profit of the apple orchard, well, we have to subsidize this producer. Well, how is the subsidy working? Well, simple. Per unit of honey you produce, I'm going to pay you $T. Who is I? I'm going to pay you, I said. Well, the government, the regulator is going to pay. Well, where is this money coming from? It's coming from the government budget, not necessarily from the apple orchard. Okay? So basically, now in the Pigouvian tax or in the Pigouvian subsidy case, we consider the situation where these agents cannot negotiate out improvement over acting independently, so they can't act jointly. The government intervenes and say, okay, you act independently, all right? I mean, you produce your apple, you produce your honey, but you know what? I want you overall 150 units of honey production and 150 units of apple production. In order to satisfy this production level, I have to subsidize the company, the firm that generates positive externality. How? Very simple. Per unit of output it produces, I'm going to pay him $T. All right? So the T is the Pigouvian subsidy. Because it's plus, it's subsidy. If it was minus, it would be Pigouvian tax. All right? Well, obviously, the taxing the guy is not going to... So, I mean, if we... Look, without tax or subsidy, the honey producer is already making loss if it produces 150 units. So in order to make him produce 150 units, we have to incentivize the firm. So we have to give him additional incentive. So we should subsidize his production, this extra 50 units of production, we have to subsidize him. Well, what should be the Pigouvian subsidy level? Well, basically, we have to maximize this, is that right? I mean, the first order condition. What level of honey will maximize this? Well, the first order condition is 2, derivative, minus 2h divided by 100 minus t, plus t. That's equal to 0, right? So if you just do the calculation, t is H divided by 50. So I just basically cancel 2 and 100, so it's 50. So H divided by 50 minus 2. All right, so this should be the Pigouvian subsidy level. But the thing is, what is H? Well, remember, I want the honey producer produce 150 units of honey. So therefore, H is going to be, I want him to produce 150 units. So that's why I subsidize him. So the amount of subsidy I should pay him is 150 divided by 50 minus 2, which is, this is 3, right? 150 and 50 cancels out, 3, minus 2, 1. So per unit of honey, the apple producer, the government should pay the honey producer $1. So therefore, basically, because he's producing 150 units, the government should pay the honey producer additional total, I mean. So T is equal to 1. H is going to be 150. So therefore, 150 total, what is it? Total tax subsidy. Subsidy. Okay? Once again, who's going to pay for this subsidy? Clearly, the apple orchard is not going to pay $150, right? I mean, if the apple orchard pays $150, its profit is going to decrease to less than $325. Well, this time the apple orchard is going to get, oh, screw it. I mean, I'm definitely going to produce independently, unless you also subsidize me. So therefore, this total money for the subsidy should be coming from the government's budget. All right. So the Pigouvian subsidy is costly because it costs the government, now the third player. So the best scenario, the socially best scenario, is that these two firms actually get together and make an agreement and produce jointly and make some side payment. All right, $20, $30. Well, $20 is not going to work. At least $25. Because the honey producer should get at least $100. So the subsidy, not subsidy, I'm sorry, the side payment should be at least $25 and at most $50. All right, but there is a possibility, a room for making a negotiation and agreement. If they can't, for some reason, if they can't agree and decide to be independent, well, still the government can actually intervene and pay some subsidy to the honey producer and let them produce the socially efficient level of honey and apple. But obviously that would be a costlier policy or costlier outcome. Okay, I hope that was clear.